Good afternoon, everyone. Thank you for being here today. So we will continue with our transfer pricing series in Malaysia, and today with a very exciting topic, top 10 transfer pricing tips for new tech industries. So I guess one of the reasons why we pick up this particular topic is because tech industry is one of the industries that are impacted the most with the rapid changes of both tax and transfer pricing. We thought that it would be worth having a forum to discuss some of the top 10 issues that we have observed in this industry, and hopefully we can give you a few tips on how to manage tax and transfer pricing risks. Before we get into the topic, let me do a brief introduction about our firm for those who are unfamiliar or are new. As the same says, we specialize in providing transfer pricing advisory to multinational groups in Asia and basically helping them to manage their transfer pricing risk. So we have 3 offices, our head office in Australia and our 2 Asia offices, one in Singapore and the other one in Malaysia, to cater the Asia Pacific region and obviously clients in both Singapore and Malaysia. We also are very excited and frequently contribute to journals both in Malaysia, Singapore, and Australia. And we are also proud to be Tier 2 transfer pricing firm in Asia. And maybe with that, I do a brief introduction. I can see some familiar names for those who already know us, but the first presenter for today will be Hon Chuan Tan, who is our Director of Transfer Pricing Solutions Malaysia and co-founder with more than 10 years of experience advising clients in transfer pricing issues and pioneer in developing transfer pricing practices in Malaysia. So we're very lucky to have managed to steal him from one of the mid-tier firms in Malaysia over 4 years ago. And we also have with us Kevin Tai, Senior Manager for Asia with over 10 years of experience in advising multinational companies in the area of transfer pricing in Australia, Asia, Singapore, and Malaysia. So, and myself, Adriana Calderon, who is the moderator for today. I'm the Director of Transfer Pricing Solutions Asia and Malaysia, co-founder of both of our firms, with more than 15 years of experience in advising multinational companies in the area of tax, international tax, and transfer pricing. I'm sure between the 3 of us, we hope we can bring some insights today that are helpful and useful for the audience. So at the end of the session, we will have a Q&A where people can post their questions in the Q&A button or chat, which is next to a chat Q&A, and we will be happy to go through them at the end of the seminar. So let's just, more than an agenda, just how we're going to conduct the webinar for today. We will be talking first about the top 10 tips or areas that are worth discussing in the context of the tech industry. Then we will be giving a key takeaway and then obviously the questions to discuss from the audience. So let's start with tip number 1. And for that, basically, I would like to invite Kevin Tai to give his insights of what is the importance of defining the IP owner, and why is this issue or a challenge that is worth discussing in the context of TP? But before that, let me just get or gauge what people in the audience understand of what is IP ownership in the context of TP, and particularly how can IP ownership be defined for TP purposes? So it would be great to hear from the audience first before Kevin starts talking about this topic, to see what is the understanding of IP ownership and how to define IP ownership in the context of TP. So the options are, the legal title defines the ownership, the creation defines the ownership, the value contribution defines the ownership, the creation and value contribution defines the ownership. So Let's give it 1 minute. We have almost 90% in less than 1 minute. Good job, everyone.
Yeah.
Okay, let me launch the results. What is your take? What do you think the majority will went for? 1, 2, 3, or 4?
I would say it's 4.
Default.
Okay.
Yeah.
Yes.
So this is, yeah, I guess this is a very interesting question. As expected, everyone will go, well, not everyone, most of it will go for 4, because why not? We have combined 2 answers into one. Usually, if you don't know which is the right answer, just pick one that covers more grounds, right? But all jokes aside, let's look at, defines IP ownership. How do we define the IP ownership, right? Nowadays, we look at one of the key, we call it main principle that we get from the OECD guidelines, from their BEPS action plans. What this principle says, actually, basically it says profit should be taxed where the real economic activities generating the profits are performed and where value is created. So now this is a very interesting concept, right? Because and also this is a very big shift from the conventional way or more traditional way of how we look at IP ownership. Maybe just to give you a bit of background, in the past, when we look at IP ownership, we look at contracts, legal ownership. Who is the legal owner and who take the risk or bear the cost in that IP? But with this principle, it sort of adds another layer to it, where it talks about, where value is created, and that gives a lot of weight to how you have to look at things at this time of age. Basically, not only the form, meaning not only the contract or legal ownership, you also have to look at the substance. And just for everyone's understanding, it's like this is not something new. This principle is widely accepted, especially in the Asia countries. For example, Singapore has already adopted this in their Singapore TB guidelines back in 2017. So yeah, this is not something new. But look, we have always talked about substance and form. Nowadays, in transfer pricing, we're getting more and more into this topic, substance over form. We are turning into lawyers. But how do we address this from a TP perspective? Okay, how do we link these two together? Okay, if you think about a transfer pricing analysis, not only on IP, on any arrangements, first point of reference will be your intercompany contracts, if you have one. All right. Why is that important? Because it gives a lot of information. Who is the owner of the IP, or legal owner at least? Who is taking up the risk? How are they allocated? And this is actually what tax authorities will come for in the audit as well. That's usually the first point of reference before they even going on discussing whether or not the pricing is correct. They will look at the intercountry contracts, and then they do their analysis, right? Okay, so from how do you then, that's your form. If you have an intercompany contract, you have a form. But how do you then substantiate the form with the substance? How do you link that together? From an outsider perspective, as a consultant, what we do is we generally do is through a robust and detailed functional analysis. What this means is basically we go in, we'll look into, we try to work out what each entity is performing that is relevant to the IP. Okay. On top of the functions, like the functional analysis, we also have to look at the risks. So a good functional analysis always have to have a linkage or an analysis into the risk, who is bearing the risk, But when we look at the risk, we also have to sort of give consideration to some important factors, the economic side, whether or not the companies that is taking the risk has control over the risk, or at least has control how they can manage the risk. And obviously, whether or not they actually have the financial capacity to assume the risk. So, yep, you go.
No, you continue.
Yep. So a good, robust, detailed functional analysis ideally will be in your transfer pricing documentation, comes together with the contracts that will give you a support on how you can define your IP owner.
Thank you, Kevin. So with that, maybe we go through a good example that can tell us specifically how to define the ownership in the context of a structure that involves IP. And I think for this one, it will be great that we give some facts to this example, and maybe everyone noticed the guy in the hammock at the top right. So what does that guy has to do with TP, and why is it important?
Yeah, so let's look at the example first, right? We'll talk about the hammock later. You have a company A, it's a holding company in the Cayman Island. And this company is the legal owner of the IP in contract. They have the contract saying that they own the IP. They are the invoicing center to the customer. They have some subsidiaries offshore. You have company B, C, D, and E. Company C, D, and E, they are what we call a routine service provider. What they do is basically they do business development and marketing on behalf of company A in their local market. So basically they are trying to sell. When you think about, hang on, we are talking about IP. What marketing are we talking about? But if you look at tech industry, it could be just a product or platform or software you've developed, okay? And for that activities, they are paid a markup on cost, okay? So very routine, it's a very common arrangements. And then now you have a company B, which is based in Malaysia. Now this company is actually the one doing all the heavy lifting, okay? They are involved in the R&D initiative, product engineering, anything that does with the product creation. And on top of that, they have also, the business development and marketing activities in Malaysia. But for that, they are also paid a cost on markup, a markup on cost. Okay. Now, if you think about the main principle earlier, we spoke about, and also the traditional way of looking at IP ownership, potentially it will be a very different scenarios. Okay. Forgot to mention, company A doesn't have employees. Okay, so if you look at the traditional way, it almost looked like what Adriana like to say is the hammock scenario, where company A is just relaxing on the beach on a hammock, doesn't have to do anything. They just owns the IP and all the profits goes to them. And this is actually what happened in the past, many years ago. Some M&E tried to structure their arrangements like this. They will set up a company in the tax-free jurisdiction, have the IP sitting there, they own the IP, and they then have sales entities across the globe, and they start charging royalty out. From there, they sort of shift their profit all the way to the tax-free jurisdiction, and they pay no tax. Okay, that is the traditional approach. Now, when we look at the new principle, yes, you also have to look at legal ownership, which is company A, but the second thing is the substance and the value creation. It all happens in Malaysia, in the company B jurisdiction. They drive the initiative, they do all the research, they bear the cost, they lead the project. So if you look at that, really, they are the one creating the IP. They should be the one that owns the IP, or at least partially own the IP. Okay, so that is the difference between the two approach.
Thank you, Kevin. So I guess the point here, which you kind of have elaborated quite well, is that before the BEPS initiatives and the all initiatives coming from the OECD, we had the potential to allocate ownership just by having a legal contract. And post BEPS, what we have is that the legal contract has to be substantiated with substance. So if you were looking at, just to summarize, how you will determine the ownership of the IP, and what would be the key points to consider?
Yeah, so some of the key points, well, you can sort of look at it like a framework when you're working out the ownership. Obviously, you start with defining the intangibles, which is the IP. You have to know what IP you are looking at. Define the legal ownership. And when defining the legal ownership, you have to have regards to the value contribution within the key value added activities. Now, these are the activities, the key activities that's required to be undertaken to create the IP. This gives value to the IP. And obviously defines all the intra-group transactions that are involved. And then obviously then at the end, define the methodology you use to price your transfer pricing arrangements, right? Now we have spoke a lot about, I guess the first 2 points, everyone is quite clear. You have to know what IP you're talking about, but to define the legal ownership, actually there's a framework provided by the OECD. If you go to the next slide, they call it the DEMPE analysis, or the DEMPE framework. Basically, this DEMPE is an acronym for development, enhancement, maintenance, protection, and exploitation. And these are some of the key value-added activities or functions that you will see in a typical IP intellectual property creation. Okay. Usually we do this as part of the functional analysis. Remember earlier we would say we try to map out what each entity does in relation to the IP. This is the same. This just gives a little bit more direction. Okay, who is involved in development? Who is involved in enhancement? Who is maintaining the IP? Who is protecting the IP? Obviously, who within the organizations is exploiting the IP? And from a mix and match of the functional analysis and DEMPE, it sort of gives you a good idea of who should be earning or who should be partially earning the IP.
That's a very good point, in the sense that, for example, if we look at the hammock example, we refer back to that. In the past, then Cayman Island will be the legal owner, and probably only, if any, performing the protection side, and quite disputable. But nevertheless, no one was asking, does Cayman exploit it or maintain or enhance or develop? Possibly could have get away with just saying I'm the legal owner by contract. Now, when you see this framework, if you put that same business structure to analyze from a taxatory point of view, they would ask the questions of is Cayman developing? Is Cayman enhancing? Is Cayman maintaining? Is it protected, or is it exploiting? And when you pair that with just maybe that person who is sitting in the hammock, who doesn't even have executive powers to decide anything associated with the business, then you really struggle to allocate value contribution activities to that little man sitting in the hammock, which is what this framework wants to counteract, that you bring back these activities to who is performing in really within the multinational group. As you pointed out clearly, probably in our example, more Malaysia than Cayman Islands, right? So one second question or a third question that it gets asked a lot is, when is the right time to start thinking about TP planning? Mainly because the setup and the growing stages of these tech companies goes in stages, right? From the moment I think about the idea to the moment I go to sales. So the question is, when is a good time to start thinking about TP planning, in your view?
Yep. Yeah, like this is one of the most asked question that we get. When is the $1 million question, right? We've got a few at the bottom. You can see there's some of the recommended timeline from the clients. So should we think about timing at incorporation of our entities? Should we think about it when we are testing the hypothesis, or should we even think about it only when we're starting to sell the developed product? To me, drawing to Adriana's favorite guy on the hammock, we should do it before you jump on the hammock, right? What it means is when you know that you are going into a project to develop a potentially valuable IP, and you requires assistance from a few entities in different jurisdictions within your group, that is where you probably start thinking about planning. Because that whatever you do, then from that point on, will have very big impact on the ownership of the IP if it's not done properly. And obviously that translates into a big impact on who has the claims to the future benefit arising from the developed product. Okay, so again, like touching on why is timing relevant, TP planning gives you a very clear strategy on where majority of future profits will be earned. It's almost like a tax planning, right? We are not saying that you need to plan it in a way that is not right, but it is a tool. It's good to have a bit of planning to know where you stand. Okay, it helps you define which entity will be routine and which will be owning the IP. Plans which entity will bear the losses, but that's like earlier Adriana mentioned, IP development usually go through a few phases. You have a development phase, you have a production phase, you have the the reward phase or the selling phase, right? The development phase, usually you will incur some losses because product's not done, you are incurring expenses. Who in your group should be taking on the losses? That is the important question. And then from that, you can sort of tell like how do you book the expenses. You make sure you book the expenses in the right entities so you don't have issues later on with the tax authorities.
That's good, Kevin. And before we talk about some of the typical business models, maybe it would be great to explain or elaborate on the importance of setting up the ownership since the beginning.
Yeah, so in the beginning, like when we set up, if you have a planning in place to set up the ownership, it sort of helps you ring fence the ownership under key entities within the group. So you need to know which entities should be taking ownership to the IP. And then again, it allows you to plan for future tax purposes in a coherent way. We want to be as transparent as possible and be able to tell the same story across different jurisdictions. That is the goal, right? And obviously, if you have planning in advance, then you can plan for, if there's any impact from Pillar 1 and 2 of the OECD initiative.
Yeah, and I think this last point is something that I think anyone in the tech industry should be thinking about, mainly because Pillar 1, for those who may not be familiar, what it involves is the possibility for countries to have taxing rights on revenues that are earned as a result of having users or consumers in a particular country, even if you don't have physical presence. So what that means is that if you are the company in the person in the hammock in Cayman Island, like we were talking earlier, and I decide to centralize my invoice in that Cayman entity, and I start having consumers in India, in Malaysia, in Indonesia, in Thailand. And if these countries decide to implement Pillar 1, I might be forced to pay tax on those revenues, even if I'm invoicing from Cayman Island. So there are some developments at the moment where some of any foreign vendors may have to register to be able to sell to consumers in a particular country. And what that means is that you're going to be facing the debate of, okay, should I just invoice from Cayman Island or from Singapore without an entity and be taxed on revenue, or should I go down the path of setting up the subsidiary or a branch to be able to be taxed on net or tax accessible income after deductions? So I think anyone in tech industry definitely need to start looking at this Pillar 1, and then Pillar 2, obviously, which is the global minimum tax of 15%. So with that, maybe I pass it on to Hon Chuan to start talking about, is it still Kevin, right?
Still me.
Yeah, okay.
I'm not ready to go yet.
Okay. I am eager to hear Hon Chuan Tan.
Go away.
let's talk about the typical business structures and that we can find within the tech industry.
Yeah, really, we can look at it as a two broad business model you can have. One is the obviously the centralized model. You have one entrepreneur and various routine entities supporting you, and you can have a decentralized model where you have two or more entrepreneurs with obviously some support, routine support entities as well. Maybe we'll look at the centralized first, this is a quite common model. Like you have, let's say, company A, you have only one entrepreneur, which is company A in Singapore. It has some a routine entity in company B doing support functions. It could be either supporting in R&D or supporting in selling the products, promoting the products in the local market, and they get paid a subcontract fee. Sales are done directly from company A to customer, including Malaysian customer, and they get the revenue from there directly. This is what a centralized model can look like. But over the years, we are seeing more and more challenge from the tax authority in this type of model, particularly when goods and software is concerned, because what this essentially is sort of, in certain tax jurisdiction, is sort of skip or sort of deprive the local tax authority on some taxes made on the revenue that you get from the license. In Australia, we have they have rulings against this, which is called the Multinational Anti-Avoidance Law, which was sort of drafted just to catch this type of arrangements. So if you go into this centralized model, you have to think about whether or not your local tax authorities will accept that if you have a company B doing sales and marketing, actively promoting and winning customers from company A, the revenue doesn't go through Malaysia, it goes directly to Singapore. Will the Malaysian tax authority approve of that arrangement? Okay, so that's the issue with the centralized.
And I think it's safe to say that even if this little company was not Malaysia, but was maybe Indonesia or India, I think you would have to ask yourself the same question. And the second point is probably whether on the customer side, whether the customers will be willing to accept a centralized invoicing from Singapore, because we do know from experience that customers may be hesitant on this. What about the decentralized then?
Decentralized is basically you have two or more entrepreneurs. In this case, you have company A, company B comes together, partnering to develop a product. You share your responsibility in terms of R&D, product engineering, anything to do with the production of or the creation of the IP. You sell it to your customer, and you get your license fee from there. Obviously, then you will have some support. You can still have some support routine entities. In this case, company C Philippines providing share service. Now, this service can be any supporting service from administration, or sales and marketing in other tax jurisdiction. But essentially, you will have two or more entrepreneurs that hold titles to the IP or share the reward from the IP.
Yeah. And then in the context of this decentralized, for example, if we keep talking about two entrepreneurs, and now I can call Hon Chan, which is, are there any options, and is cost contribution an option for this decentralized model? And what are your thoughts on that?
Yeah, as Kevin has showcased earlier on the decentralized model, one approach that we can look at is actually the cost contribution arrangement, CCA, where there are basically contractual agreements between related parties to share certain costs and risks to develop or produce their set services or rights, and also then to determine the nature and the extent of which the interest for each participant in respect to the assets and service of rates. So if you look at the example here, similar to a decentralized model, we have two R&D teams located in Singapore and India. Bear in mind that both teams would have their own autonomy in respect to their R&D activities. So they have their own control, they have their own functions to actually provide R&D services to develop the IP. Right now, for CCA to happen, the first step, I'll briefly talk about the few steps. The first step of the CCA is to determine the participants, which are the Singapore and India. And then from there, we'll need to, determine each participant's share of benefits, right? After which, we'll need to determine the arm's length value of each participant's contribution. And lastly, the allocation of the CCA contributions to each participant, which should be in accordance to the respective share of expected benefits so step 2 and step 4 should be in line so that both parties will contribute and earn the expected benefits in accordance to the ratio. Now, if you look at the CCA, right, the pros of CCA within the group is you're exploiting the economy of scales, right? You're reducing duplication within the group, increasing operational effectiveness, also sharing of the risks, and more importantly, especially exploiting knowledge of each team. So you have Singapore team and India team, both teams would have their own knowledge, then they can actually share the know-how and make sure that both teams would have their own best practices. Overall, it improves the group's performance and obviously the competitive advantage as well, right, to have a CCA in place. While the pros are there, the risks of having a CCA is that it will be scrutinized by the tax authorities, right, to ensure that most importantly, it will not be recharacterized into a service arrangement, which will have a huge impact to the overall arrangement. Here, I would like to highlight the difference between a CCA and a service arrangement, where if you look at the CCA, we are basically sharing costs and the risks, while a service arrangement, on the other hand, is more of a cost plus a markup element. So you have an additional element, which is the markup element. So imagine when you have a CCA arrangement and the IRB comes in and tell you that, oh, I think your CCA arrangement is not valid. I'm going to recharacterize you into a service arrangement transaction. Then you need to look at, they'll add on a markup element, which will blow up the whole arrangement right there. So here, it's very important to ensure that if you have a CCA, you need to make sure that all the steps mentioned above are properly documented down into the agreement itself.
Yeah, and in the substance as well. So if we go back to our decentralized example that Kevin was showing earlier, one could think about equally a CCA, but I think you have pointed out really well that it has to be set up properly to reduce the risk of a TP adjustment for a markup. So once one is define the IP and go down the path of one of the business models, what methodologies are available in the context of tech industries, and what is the view on that from Malaysia point of view?
Yeah, in Malaysia, in contrast with the OECD guidelines, we still follow the hierarchy of methods where we still need to assess whether the traditional methods are appropriate. So the traditional methods are your comparable uncontrolled price, resale price, and cost plus methods before actually applying the profit methods, which are your transactional net margin methods, and the ever increasing focus is the profit split methods, right? So profit split method is currently under the spotlight for these scenarios where you would have a highly integrated business operations that cannot be reliably evaluated in isolation, and you have unique and valuable contributions by each party, like the example that I've given earlier on the decentralized model. That's where profit split may be applied.
So what we're saying is, in which instances are traditional methods possible in your view?
Yeah,
If
I
we go
guess
back to the
traditional.
examples.
So if you look at the examples, right, traditional method would be possible when there's a presence of reliable comparables to test the respective transaction, which in the example or in the intangible segment, that may not be the case. I think a lot of cases where we have lack of reliable comparables, or rather, not even have a good comparables in that sense. That is when profit split will be possible, right? So, but having said that, the absence of the comparables does not mean that you automatically result in a profit split method, right? So you need to make sure that you satisfy all the requirements. As I mentioned earlier, you need value contribution, and you have a highly integrated business operations. Well, for profit split method, there are two types of profit split, right? So one is the contribution analysis, and one is the residual profit split analysis. To simplify, the contribution analysis is basically weighing the value contribution by each party, right, Singapore and India, and then split the profit accordingly based on the contribution by each party. While if you look at the residual profit split, it first look at the routine activities of each party, and you split, you determine the routine profit for each profit party, and then after which you split the residual group profit based on an generally objective allocation factor for the residual profit split. Now, I guess for those that are interested in profit split method, we had a recent webinar that we have done previously, this last month. So you're interested, you go back last month and look at the webinar.
Yeah. And I guess there is another point in the profit splits, but that there is a general practical view from what we can gather even from our experience and other peers, which is that tax authorities tends to get a bit uneasy on contribution profit split because there is no element of benchmarking. So usually when it comes to a profit split, the tax authority may be more comfortable with the residual because you have some elements of benchmarking as well. But again, it's something that needs to be done as a planning exercise and not after the setup, because the profit split requires some proper forecasting of the group total profit and total revenues to be able to apply it in a reliable and objective way. So how about legal agreements? What is the role of the legal agreements within the tech industry? And one typical question that we get asked is that maybe you can think about after you go through points is, okay, if I go down the path of a profit split or a residual profit split, is my legal agreements also important? But let me just pass it on to you to just talk about the importance of legal agreements.
Well, I hope everyone knows by now that legal agreements are actually very important now, right, at present. And again, I would like to emphasize the importance of having a legal agreement in place, right? Because now, in the event of an audit, that's one of the main documents that will be requested by the tax authorities, right? So you will not be able to gone past that, right? Gone are the days where, last time IRB will come in and ask just for the TP documentation, and that's it. Now there's an extra document that is required to, further defend against your TP position only when you have it done properly, right? So it's very important to have a complete and accurate agreement with which clearly document down the ownership together with the substance, as Kevin has mentioned earlier, right? That's one of the main things. Then the type of intra-group transactions that are put in place, the allocation of risks of between the parties, the key activities that are performed by the respective parties. And lastly, an interesting fact is that the agreement can be used to support your TP adjustments performed at year end, and for you to actually manage your intercompany balances as well, right?
Yeah. And I think even where you're following the traditional methods or where you're following the profit split, I think there is a need also to document the profit split within an agreement, because that will give you the substance, apart from the TP analysis, to be able to do any adjustments to implement that profit split properly.
Exactly.
Okay, as much as we love TP has everything to do with tax, so, or very much interlinked with tax. So what other tax considerations should this industry keep in mind in the context of the typical transactions that you get in tech industries?
Yeah, I think other taxes, previously we keep talking about TP, right? And we also want to, again, emphasize on other taxes that may be affected through TP, right? So the obvious one would be the computation of your assessable income and deductibility, right? The starting point is to set up, when you set up the transfer pricing model correctly, the key milestone would be to address the deductibility issues for services transactions, where if a service fee paid to a related party is deductible under the general tax principles and is considered a business expense. Again, example where a Singapore entity pays a service fee to Malaysia, the expense is deductible for Singapore entity as long as it is incurred solely for the production of income, right? So that's the overall corporate tax. The TP policy is the key to support the deductibility, as the tax authority will challenge the deductibility based on your TP principles. In particular, your benefit tests and the value of the charge. You have to go through all the chargeable and non-chargeable process to make sure that all these the service fee is actually deductible. Right, that's one of the examples that under the corporate tax. Now, the next important one is the withholding tax, right? Where we deal a lot with international taxes, where it is an important consideration for interest and royalty payments, as they generally attract withholding tax in the country where the pay is located. In relation to royalties, for example, there is an sort of an implication in relation to definition of royalty versus license, where in some countries, licenses do not attract withholding taxes. But this is actually very much dependent on the local withholding tax law, as well as the double tax agreement between the respective countries. Right, so please bear in mind for interest and royalty. And obviously for services transaction as well, withholding is also a consideration, but in some countries, payment for services may not attract withholding if the service is actually performed outside of the country. For example, payment for certain services made by a Singapore company to a Malaysian company are generally not subject to withholding tax as long as the service is performed outside of Singapore, right? Lastly, we also would like to look at other taxes as well, right? Your sales related tax, your GST, goods and services tax, your value added taxes, or your sales services tax, which will actually complicate your transfer pricing. It actually will add up and how your transfer pricing as well. So better in mind.
Yeah, I guess with the fact that the transfer price a lot of the time is agreed before tax, then other taxes is a consideration to see the overall tax implication of the transaction, right? Mm-hmm. And lastly, your favorite, I know this is Hon Chan favorite topic. What does transfer pricing and tech industries have to do with grants, and what type of grants, and why is it important?
Yep, I'm sure you guys are aware Malaysia is home to a lot of grants and incentives to taxpayers, especially now in the tech space. Because the main point is to promote the development of a comprehensive digital ecosystem in Malaysia, right? You may be aware that there are tax incentives provided to companies already in place in the digital and tech sector, like your MSC tax incentive. But there are other development as well. So if you're aware, the recent budget announced a tax incentives under the DSAC, DSAC, which is the Digital Ecosystem Acceleration Scheme, for mostly for digital technology providers as well as digital infrastructure providers. Right, there will be more info in place going forward in relation to what are activities that actually applies to these two providers. Right now, what I need to discuss is more, maybe not tips, but traps on all these grants and incentives, where a lot of companies, they include, one of the things is inclusion of grants in their cash flow model for more than the period of the grants, which would have further inflate the value of the IP trade. Now, the issue arises when an independent valuation is performed and the actual value of the IP would have been much lower, because you would have, gone past the grant period, but then you still further inflate your value. And then comes the independent valuation, then you realize, oh, the actual value is actually much lower. And in TP, that would mean that you would not satisfy the arm's length condition, so to speak. Now, with more guidance provided by the recently released OECD TP guidance on hard to value intangibles, we can expect increased scrutiny by the tax authorities in this complex area, right? And the next point is the inclusion of grants when calculating your fee charges in a service transaction, where the provider is essentially passing through the benefit of the grant to the recipients, right? Bear in mind, grants are provided to you for the benefit of the provider, not the recipient, right? It should stay with the provider. So in this case, you have effectively undercharged your service to your related party, which will mean that we may more or less not satisfy the arm's length conditions again, right? That's the second point. Last point, which is equally important, is the lack of DP policy during the tax incentive period. Now, based on my experience, I've seen taxpayers that are enjoying, I think, yeah, same with the hammock metaphor, where you're enjoying the paradise, right? You think that tax incentives will last forever. I pay zero taxes, and then when comes the tax incentive period, you finally wake up to reality, and you realize, oh, we seems to be charging too much on our royalties or services or whatnot, and we'll be paying a lot more taxes later on when the tax comes in. Let's reduce our charges and then go back to normal, right? So unfortunately, that doesn't work. It doesn't work that way, right? Tax authorities, IRB, will be scrutinizing those that are coming out of the tax incentive period to ensure that the profits that you earned previously are consistent with going forward profit. So if you're undercharging, then you have lower taxes than previous years. That will absolutely provide it. It's a red flag to tax authorities to catch you and ask for more of your TP policies and what you've done previously and what has changed post tax incentives. So bear that in mind.
Thank you, Honchan. That's really good insight. And I will say that it doesn't apply exactly the same, but I guess in certain countries where there is incentives, and I think the spirit of the incentives is for them to stay in the country that is giving the incentives rather than benefiting head office that is located somewhere else. So that's something to keep in mind, I think, in any country that you're applying for incentives. Okay, so before we open for questions, just quick wrap up or key takeaways. So you want to go through it, Kevin? What are your 2 key takeaways or 3 key takeaways?
Well, as I say that, have think early when you are going into an IP arrangements, where you want the IP to be. Obviously you have to back it up with some substance. So substance is king. Obviously, to do that, you need to have some support. Functional analysis can help in your TP documentation, and don't forget your legal agreements. They are also a key because they are the starting point. So if you have these two together, I would say you're halfway there. The next one will be pricing.
Great. So maybe with that, we can open for questions. So far, we don't have any, but if anyone wants to ask any questions, now is a good time to put it in the Q&A if you have any. Let me see what the chats are. There is no question so far.
So either we have explained it really well or we have confused everyone, right?
Looks like.
Well, if we don't have any questions, just there is one question in the chat in 2 seconds. Okay, would you be sharing the slides? We will be sharing the recording afterwards that has the presentation. There is one question. This is a good question. How to charge the IP? Can it be within the price of goods that you charge?
Yeah, I think well, it depends on your arrangements. So if it could potentially be within the price of your IP. It depends on how you price it. Like let's say, for example, you keep it at the other party as a limited risk. You give them a fixed markup. Essentially, then you are already, recuperating the IP from your charge, your pricing, because they are only entitled to a limited markup, limited guarantees, right? I mean, limited profit.
Okay, so in the for example, if I have luxury goods and I decide that I just do a distribution routine, then basically I'm saying that I'm only giving you routine profit, and the same I'm keeping it as the owner of the brand, basically.
Yep.
That's a good way of looking at it. How do you see impact of OECD two-pillar approach? I'm just putting it live. In the given scenario for IT companies, how do you see the impact of the OECD two-pillar approach in the given scenario for IT companies? I can take that.
Okay.
Pillar 1 and 2 is one of my topics to become favorite for me these days. I found it really interesting, but because it's really changing the way you do traditional tax. I think we spoke about it in one of the slides. So for pillar 1, I think the first thing that you need to understand is you are within the scope. So for example, if your industry, IT companies, is within the scope, if it is within the scope of pillar 1, then you have to think about places where you are selling products or offering services without physical presence. Because if you have those situations, you may have to pay tax there. And then you have to make a decision on whether you want to set up a physical presence or not, and which scenario gives you the less tax impact possible. That's for pillar 1. I think pillar 1 is essentially something that those who have a lot of sales of services or products in places where they don't have any presence, they have to start thinking about what to do about that. And I think on pillar 2, it will be, again, see if you are within the scope, because the scope of pillar 2 is only for multinational groups. I think the threshold is 1 billion of group revenue. If you are within the scope, then you have to calculate your effective tax rate and see whether there is a need for top-up or not. And then maybe think if there is a way to set up your or change your business that has the lesser impact in the context of the top-up tax. That's probably my answer to this. There is another question. in which cases you need to charge IP separately? If so, how do you determine the charge for separate IP?
I think that's what Kevin has gone through, right? I think you first need to determine
Yeah, so I
then
guess a good way is it depends on your arrangements. Let's say, for example, I just give you an example, because earlier we say that, you know, if we don't want to charge an IP, can we build it in the price of the goods? That's what we have discussed earlier. Yes, we can, but what if you want to charge it separately? The arrangement will be somewhat different. I will give you an example where the IP owners license, give you a license, give you a rights to sell and distribute the product. They don't cap how much you're earning. You are free to negotiate and keep the profit as you like, but you pay a percentage of what you have generated from the IP as a royalty fee. And that's the arrangement that you can charge it as separate. And how you determine that? A few ways. Usually we call it the comparable uncontrolled price method. You can do it either through a database where you can find pricing information on similar products or similar IP. Sometimes it's quite hard depending on what IP you're looking for. Or if the IP owner also provides similar licenses to a third party, that can be used as a reference as well.
Okay, so I found this one interesting. Do you believe that Pillar 1 is dead? I guess the reason why this person is asking is some countries are tackling the purpose of Pillar 1, which is taxing based on users via indirect tax. So remember, I was just discussing with the two of you the regulations, at least in Singapore, for registration of foreign vendors for the purpose of attracting GST. So I think what is not that is dead is that there has been unilateral actions to address the issue of revenue not being taxed where there is no physical presence via indirect tax.
Is it me or hello?
Maybe it's her. I'm like, oh, I thought it's me.
Sales tax, right? Okay. So
Adrian, I think you got cut off earlier. Maybe
sorry.
You have to explain it again.
Stage was I cut off?
Which stage, Kevin?
Sorry. Pillar 1. Okay.
Yeah.
So essentially, what I'm trying to say is that Pillar 1 is not dead. I think it's being addressed unilaterally via indirect taxes in particular countries where there is foreign registration registration of foreign vendors for the purpose of making sure that they pay indirect tax. For example, Singapore, GST. Okay. So I'm not sure, I don't have a crystal ball to say that it's totally dead. I just feel that the short solution has been to address it via indirect tax.
I think there's one more question in the chat.
In the chat.
Okay, so what does that say? What will be the situation of a company who is already messed up and halfway into their business operations? Example, Malaysia operations supports the business in its marketing legal activities. Singapore company owns the IP, but billing and revenue happens in India. This may need a deeper review.
Yeah, I like the word messed up. I think that's what we have always experienced before, because in Malaysia especially, TP awareness were not there until maybe 2014 or 2015, 2016, where the education caught up, and then these operations had already had their own pricing policy in place where it's messed up. I think another thing is we need to take a step back. We look at all your supply chain, right? When we talk about TP planning, it doesn't mean that it needs to happen before it happens. TP planning can also be done when you already have all this supply chain or transaction going haywire. Take a step back, look at your supply chain. It's good to have a TP plan in place to relook at all the services, all the invoicing, all the transaction in place for each jurisdiction. Look at each jurisdiction's local TP requirement. And then from there, plan again as to how best to overall reduce your TP exposures. I think that's the main thing, is to look at your current TP exposure and then plan to reduce or minimize your TP exposures using a restructuring on the supply chain if possible. What are your thoughts, Kevin?
Yeah, I think to add on to that, right? Like you say, you think currently the transfer pricing might be a bit messy, might not be 100% right, but it's still worth looking into it, having a review. At least when you do the study, you get an idea of your exposure. If it's not right, how big is the impact, right? And whether or not you want to do a voluntary disclosure to the tax office, right? It could be a matter of fact, yes, it might be wrong, but the dollar value is really not that material. And if it's a material, then potentially you want to think about some damage control. How can you minimize the risk? Do you quickly approach the relevant tax authority to discuss, look, we are not doing this on purpose. We didn't know about this. Let's talk, let's sit down and talk and see how we can resolve this. So I think that's a more practical approach. You can apply. But yeah, we're happy to chat if you need help.
Yeah. Excellent. So I think with that, we can conclude our webinar for today. So as Hon-Chun pointed out, if you want to learn about profit split and other in detail, we have a lot of videos in our YouTube channel available for everyone. Please like us and subscribe. We love posting videos in there. And we have a very busy webinar agenda, as you can see here. We have a few webinars upcoming. In April 26, staying ahead of transfer pricing trends and developments. In Asia, travel to Malaysia on the TP highway, which is basically a transfer pricing overview of Malaysia versus Singapore. That is the 6th of May, 19th of May, top tips for small multinational enterprises, and 23rd of June, top tips for manufacturers and service providers. Thank you everyone for attending today, and speak soon. Thank you, Hon-Chun, and thank you, Kevin.